All right, let's jump right in. Picture a freezing winter evening in 2007. We're at a high-stakes charity poker game at the St. Regis Hotel in Manhattan. Now look around the table. You're probably expecting loud, cigar-chomping Wall Street traders, right? Well, actually, scratch that. Instead, you're looking at physicists, code breakers, and computer scientists. Pure mathematical masterminds. Sitting there, watching them stack chips, you kind of have to ask yourself, how exactly did a group of quiet math nerds become the absolute masters of the financial universe? I mean, how did we go from dissecting corporate balance sheets to trusting literally massive chunks of the global economy to pure, unadulterated code?
To really get that, we need to look at the massive friction these guys caused when they showed up. Warren Buffett famously said, "Beware of geeks bearing formulas." And honestly, that hits the nail on the head. It perfectly captures the central conflict of this whole explainer. Traditional investors, they look at the fundamentals of a business, right? So when they see these new algorithms, these completely impenetrable black boxes of code, they immediately question their safety. Because think about it, if no one but a PhD in quantum physics actually understands what the trading model is doing under the hood, is it a stroke of absolute genius, or is it a ticking time bomb just waiting to go off?
For decades, traditional trading floors were, well, they were pure chaos. Loud, aggressive rooms full of screaming brokers running entirely on gut instinct, tight relationships, and raw human emotion. But jump to the 1980s, and zooming right through the 90s, that chaotic world was systematically replaced by the cold, silent precision of supercomputers. Enter the quants, short for quantitative analysts. These guys didn't care about a company's charismatic CEO or a flashy new product line. No way. They cared about complex mathematical models, gigantic data sets, and calculating probabilities down to the absolute furthest decimal point. They took all that chaotic human emotion and just deleted it from the equation.
Now, this whole mathematical takeover didn't just happen overnight. And hey, if you've been following our previous explainers, some of these heavy hitters are going to sound very familiar. It really kicks off in the 1960s with Ed Thorp. Remember him, the math professor who cracked blackjack and then dragged that exact same logic over to Wall Street to exploit mispriced bonds? Then, the 70s roll around, and Fisher Black and Myron Scholes completely rewrite the rulebook on options pricing. By the 80s, you've got Jim Simons, a former Cold War codebreaker, launching Renaissance technologies and actively avoiding finance bros to hire obscure scientists instead. And then in the 90s, a young Ken Griffin is literally trading convertible bonds from his Harvard dorm room, laying the groundwork for the massive Citadel empire. These guys, they were the real architects of the new Wall Street.
And the secret sauce fueling this whole revolution? It's a concept we've dug into before, the Kelly Criterion. It's basically a mathematical formula that tells you exactly how much of your bankroll you should bet to maximize your returns while, crucially, controlling your risk of going completely broke. Ed Thorp used the Kelly Criterion to engineer market arbitrage with just, well, religious precision. He wasn't gambling, not at all. He was hunting for tiny, almost invisible pricing errors in the market and betting the statistically perfect amount of money on them every single time. This right here was the bedrock of the quantitative revolution, using rigorous, undeniable math to completely conquer unpredictable risk.
And the results? Absolutely mind-blowing. I mean, traditional funds were throwing parties if they hit a 10% annual return. The S&P 500 historically hovers around, 8%? But Jim Simons' legendary Medallion Fund, it was cranking out returns well over 30% year after year after year. It completely broke conventional finance and left traditional investors totally baffled. How? Because pure math and code breaking had successfully replaced gut instinct. Simon's supercomputers were spotting these invisible market mispricings, patterns so incredibly subtle and fast that a human eye would literally never see them. They weren't trying to guess what the evening news would say. They were just reacting to live market data faster and smarter than anyone else on the planet.
But you know how it goes. Success breeds imitation. And this is where our story takes a pretty dark turn into the absolute hubris of the 2000s. As these pioneering quants got insanely wealthy, every major bank and hedge fund wanted in on the action. So they hire their own math PhDs, they build their own massive supercomputers. But here's the catch. Because they're all looking at the exact same historical data and using the exact same academic theories, their algorithms inevitably started arriving at the exact same conclusions. Welcome to the crowded trade. Suddenly, you have thousands of supercomputers deploying identical trading strategies at the exact same time. It created this invisible web of systemic fragility, all while everyone operated under the highly dangerous illusion that they had risk totally figured out.
Which brings us to a massive practical question. What happens when something totally unprecedented actually occurs? Enter the black swan.
A black swan is an extremely rare, huge outlier event that simply does not exist in the historical record. The fatal flaw of these hyper-complex quant models was their heavy reliance on normal statistical distributions. They basically assumed tomorrow would look a lot like yesterday. They completely failed to account for the crazy, chaotic, completely irrational events that sit way outside their perfectly ordered datasets. The math itself was totally flawless, but the algorithms, they had absolutely no idea how to factor in blind human panic.
And man, did that panic arrive. The August 2007 quant quake was this terrifying prequel to the massive 2008 meltdown. It was a pure algorithmic death spiral, and it happened in the blink of an eye. Step 1, unforeseen subprime mortgage defaults triggered unexpected losses. Step 2, in response, algorithms across Wall Street automatically fired off auto sells to cut their risk. But remember that crowded trade we just talked about? Because everyone's algorithms were identical, they all tried to dump the exact same assets at the exact same millisecond. Step 3, market liquidity instantly evaporated, because suddenly everyone was an automated seller and literally nobody was buying. Which leads to Step 4, forced deleveraging, sending the entire market into an absolute freefall.
The really hard truth of the 2008 era was that these highly sophisticated models didn't actually eliminate risk at all. They just redistributed it, amplified it with massive amounts of borrowed money, and then, eventually, detonated it. The sheer scale of wealth that just evaporated in a matter of days was horrifying. When market correlations unexpectedly spiked, meaning stuff that was supposed to be ultra-safe suddenly nosedived right alongside the risky stuff, the heavily leveraged algorithms had no human intuition to step in and yell, "Stop." They just blindly followed their codes straight into the panic, ironically fueling the exact crisis they were built to prevent.
But look, the quantitative industry didn't just pack up and die after that crash, it evolved. Fast forward to the landscape today in 2026, and we've got some hard-learned rules for modern, sustainable risk management. First, expect the unexpected. You have to build systems assuming your historical models will occasionally just fail. Second, implement really robust testing. I'm talking about extreme outlier events, not just your everyday market turbulence. Third, avoid over-optimization. A model tailored perfectly to the past will shatter the second the future looks different. Fourth, understand your model's real-world impact. Algorithms moving billions actually affect the real economy, not just spreadsheet numbers. And fifth, maybe the biggest takeaway, maintain human oversight. The machines are brilliant, absolutely, but you still need a human hand on the wheel when the road suddenly drops off.
So we leave you with a question that still hangs over every modern trading floor today. Your models can predict the market, sure, but can they predict human panic? No matter how elegant the math is or how blindingly fast the supercomputer runs, markets are ultimately made up of people. And people? We're messy, we're emotional, and we are profoundly unpredictable. Algorithms absolutely conquered Wall Street, but the ultimate limit of their control will always be the sheer unpredictability of human nature. This explainer honestly just scratches the surface of this fascinating stuff, so keep questioning the formulas, keep investigating the data, and keep learning.